Good morning, everyone, and welcome to our IFRS 16 webinar related to leases. The purpose of today is that we go through some practical experiences and challenges together. The logistics for the webinar, together with in line with the other webinars we already have had, all participants are automatically muted. The webinar will last a maximum of 1.5 hours. You can raise your questions through the GoToWebinar app via the questions button. Please address both the host and the panelists. After the webinar, you will receive a short poll to evaluate our webinar. The webinar will be recorded and will be made available afterwards on our website and on the YouTube channel. And to conclude, the slides are also available for download in the GoToWebinar app in the section handouts. So we already have had a webinar on IAS 38 and on IAS 19, who will become soon available on our website as well. Today we have the IFRS 16, and on the December 13th, we have the ESMA priorities and enforcement actions and the IFRS updates and ASAF. The first topic we want to address with you is the lease identifications. So as a quick reminder, we here see again the definition of a lease. So a contract is a lease or contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for a consideration. An important reminder here is that your period of time, it can also be described in terms of an amount of use. So for example, if you can use a car for a certain number of hours, that's also a period of time. The period, it can also be a whole period or a portion of the period. Important in this definition is the definition of an identified asset, and we want to go through that definition together with you and go through some examples to make the definition more clear. So the first requirement to have an identified asset is that the asset is explicitly specified in the contract, but it can also be implicitly specified at the moment the asset is made available to the customer. So for example, if you lease a car where the specification of the car is already defined, but you do not have had your serial number yet. So for example, you know, I will lease a Q4, an Audi Q4, but I do not know yet the serial number, then still you have an identified asset, because at the moment you receive the car, when the asset is available for you, it will be fully specified and you know the serial number of your car. Some practical examples on the period of time. So for example, if you have a contract which is perpetual, which gives you a perpetual right to use, access and cross a specified piece or land. In this definition, you have a specified asset because it's a specific piece of land, but it's not complying with the definition of a lease because it's not for a specific time of periods. It is perpetual, so it is never ending. Nevertheless, important in this topic is that some of the perpetual contracts, they may seem maybe perpetual, but in fact they are term-based. So for example, if you have a very long-term contract of 99 years, it is compliant with the definition. So it's a very long time, but there is a specific period of time, so it is defined, it is a lease. If you also have, like, for example, a contract which has a non-cancelable lease term and it is automatically renewed, then it also looks like it is never ending, it is perpetual, but still it complies with the definition because it will be an in substance fixed contract for a certain period of time, and afterwards there are also some optional renewal periods. Although the automatically renewal is in place, you still need to work with optional renewal periods. Another example is that you have the right to use a specific minor source without a specific period of use. So here you still have specific period you can use the asset, because your source will be limited. Your source will be not available forever. There will be an the source will be it will end. Your source is not never ending available. So in C it is limited in periods, and it can only be used for the period on which your source still exists. Also important in the definition is that you need to have a look at the capacity portion of an asset. So for example, if you're renting one floor in a building, you're only having a capacity of the building. In investigating the capacity portion of the asset, it's important to decide whether your that capacity portion is physically distinct or not. In case it is physically distinct, you have an identified asset. In case it is not physically distinct, there is a possibility that you do not have an identified asset, unless it is you have substantially all of the capacity of the asset, and thereby you have substantially all of the economic benefits. So on this slide, we see again some two examples. So assume you have the right to use 3 fibers exclusively, while there are 20 fibers available between 2 locations. So then you have an identified asset. So you only have 3 of the 20 fibers. So it's a capacity portion, but they are physically distinct. So it is an identified asset. In the next case, if you just have the right to use the transportation, if you have the right to transport electricity from point 1 to point B over the ELIA network, but you are not the only customer who is using the ELIA network between location A and B, then potentially you do not have an identified asset, because in that case your network that you are using is not physically distinct, and on top of that, because there are a lot of other customers who are using the network, you do not substantially have all the economic benefits of the cable. So it's always important to really, if you think you have a lease, to really investigate, okay, do I really comply with that definitions? Because there are some exceptions which needs to be investigated. The second requirement is that there can be no substantive substitution rights at inception date. So a substitution right is substantive if 2 conditions are met. So important is that both conditions need to be met together. So the first one is the supplier has the practical ability to substitute the alternative assets through the period of use. So for example, if you as a customer can prevent the supplier to substitute the assets, then the substitution right is not substantive. Or practical ability also means that it is the alternative asset is readily available, or it's available within a reasonable period of time. The second condition is that the supplier would benefit economically from exercising his substitution right. So meaning the economic benefits will be higher than the economic costs. So for example, if the asset is located at the customer side and not on the supplier side, the cost will potentially already be higher than the other way around. If the asset is available on the supplier's premises, then it will be easier to substitute the assets. When investigating whether your substitution right is substantive or not, it's also important that if it's the supplier can only on or after a certain date or an occurrence of a specific event can substitute the asset, then it's also not substantive. The substitution right is also not substantive when the supplier can only substitute the asset when the underlying asset is not operating properly. So for example, if you are leasing a car and there is an issue with the car and you receive another car for the time that your car will be in reparation, then it's not a substantive substitution right because your asset was not operating properly. Also, when a technical upgrade is made available, that's also not a substantive substitution right. So a common example that we see here, where the supplier really has a substantive substitution right, is when you're renting an office space, but it's not yet certain which exact space will be available for you. So it's an open workspace. You know I will have a place available, but you do not know what exact place will be available for you. Then potentially the supplier has a substantive substitution right. Another common example is parking spots. If you know you have a parking spot reserved on the parking, but it's not predetermined which parking spot is for which company or for which lessee, then there is potentially also a substantive substitution right. So the second requirement is also important to investigate whether it's applicable on your lease or not. On this slide, so within Finvision, we work with the Global Lease Center tool to make our IFRS 16 calculations. And we just want to show you that in that tool, those questions are available. So for each contract you enter in the tool, you will already need to assess those several parameters. So for example, here you need to identify, okay, do I have an identified asset? You need to have a look whether you have substantially all of the benefits. And for example, here, if you also need to investigate who has the right to direct how and for what purpose the asset is used. If it's just a customer, okay, you will have a lease. But in case, like for example, if it's neither the customer or the supplier, then some additional questions pop up to really make the complete assessment. So potentially in other tools, those questions are also available. If they are not available, or if you're doing your IFRS 16 calculation, for example, in an Excel file, it is really important that this is step one, that you, in first instances, determine, okay, do I really have a lease? The second topic we want to discuss is lease payments. So in your lease liability, the main basis of your lease liability will be your payments. An important thing that we want to stress there is the difference between an in-substance fixed payment and a not in-substance fixed payment. So for example, a payment which is depending on an index, so it can be the customer price index, for example, or if your payment is depending on a rate, for example, the Euribor or the Libor, you have an in-substance fixed payment. Because your payment, maybe it looks like a variable payment, but still in substance, it is unavoidable. You will know, okay, the payment will always be a certain amount. It will never be zero in case your payment is depending on an index or a rate. Examples of a not in substance fixed payment is, for example, if your lease payment is performance based. So if your lease payment is depending on the percentage of revenue that you have, let's assume in your shop. If you do not have revenue, your lease payments will be zero, so they are avoidable. That's why it's in substance fixed and it's seen as a variable payment. Another example is usage-based. So, for example, your lease payment is depending on the number of hours you drive a car or you fly a plane, or your lease payment is depending on the amount of electricity that you are using. That's also a not in substance fixed payment because the payment can be zero if you do not drive the car, if you do not use the electricity. So the in substance fixed payments, those need to be included in your lease liability, but the not in substance fixed payments need to be excluded and will just remain in P&L where they are recorded for local GAAP. So those in substance fixed payments, you need to include them in your lease liability calculation at measurement date. And so it's mainly the payments depending on the index and the rates. And there it's important that you use the prevailing index and rate. So that's the rate at the inception date of your contract. So you do not already take into account potential indexes that you expect in a later phase. Then subsequently, you will remeasure your lease liability using the revised index or rate. So that will be on the modification date. So that's also what is shown here on this slide. So here we have an example of a 5-year lease with a yearly payments of €1,000. And the lease payments are depending on the customer price index. So at initial measurement, you just calculate your lease liability by taking into account 5 years payment of €1,000 per year. Then subsequently in year 2, you know that the index has changed from 100 to 105. So meaning at year 2, you will remeasure your lease liability and take into account the indexed amount, and you calculate your lease liability based on the €1,050 instead of the €1,000. Then maybe afterwards, substantially in year 3, you have again an index and you change your lease liability again for the updated index amount. So we just want to stress, at the beginning of your contract, you do not already take into account the index. You do not need to make an assessment of the index. It's just at the moment that the indexation has took place, then you will remeasure your lease liability. Here you see also an example of a usage-based payment. So that was the not in substance fixed, in which we expect that it's not included in your lease liability. So assume again we have a 5-year lease and your payments are €6,000 per year if you drive 20,000 kilometers per year. If you drive more than 20,000 kilometers a year, you need to pay an additional amount of €0.50 per kilometer. So this means that your lease liability is calculated based on your on the yearly payment of €6,000. That's at initial measurement date, but it's also on subsequent measurement date, because the amount that you need to pay, because you, for example, from year 1 to 3, you drive 25,000 kilometers, so that's more than the 20,000 kilometers, and you need to pay an additional amount. That additional amount, it just remains in your P&L in the year in which it's applied, and it does not impact your lease liability. Another example is the performance-based variable payments. So that can be the case if you, for example, lease a store space. You know your historical revenue is €90,000 per month, and your lease payments depend on your on the monthly revenue. So in case your revenue is below the €60,000, then your rent will be 0. If it's between 60,000 and 100,000, then your rent will be €20,000. If it's more than 100,000, your rent will be €30,000. So the payments are clearly variable in this case, and you need to determine, okay, is it now in substance fixed or not in substance fixed? Because there is no fixed minimum and your rent can even be 0. In this case, you have a not in substance fixed payment, meaning that it cannot be included in your lease liability and that the full amount will remain in your P&L. So even though that you have knowledge of your historical revenue, still you do not need to record the lease liability for this contract, because the payments are structured in a way that they are not in substance fixed. To conclude, also an example, it's based on the question we received from one of you via the mailbox. Yeah, how do we handle rent-free periods? So let's assume we have a 1-year contract and we have a payment per quarter of €30,000, but the Q1 is a rent-free period. So in that case, for Belgian GAAP, on a quarterly basis, you will have the cash out of €30,000, except in Q1, of course, because that's the period for your rent-free periods. If you book Belgian GAAP correctly according to the CBN advice, even though you have in Q1 no cash out and no payments, still you need to recognize a rental expense because you need to divide your total cost of €90,000 over the complete period of 4 years by booking an accrued expense. But so if this is your Belgian GAAP booking, okay, what do we expect in IFRS? So for IFRS, we will have the same cash out. That will not change. Important here is when you need to calculate your assets and liability, you need to calculate it as from the start of your lease. So you will calculate it as from the 1st of January 2023. It's not because your Q1 is rent-free that you will only calculate and book up your right-of-use assets and lease liability as from the end of Q1. No, it will already be at inception date. You will calculate your assets and you will calculate your liability, and you will depreciate your asset over the four quarters. Your lease liability at the end of Q1, it will increase because you have the unwinding of your discounting impact, and then as from Q2 until Q4, you will have a decrease in your lease liability because you have made your payments. So the difference between Belgian GAAP and IFRS, your cash out will be the same in both cases. For Belgian GAAP, you will have a rental expense, while for IFRS, you will have a depreciation expense and a financial expense. So that's the same for all IFRS contracts. But important here, the accrued expense that you have for Belgian GAAP is also not required for IFRS. So if you book correctly according to the CBN advice in your Belgian GAAP books or other local GAAP books, it's important that if you have a rent-free period, you calculate your IFRS 16 impact, that you reverse that accrued expense, because it's in IFRS it does not exist. So on these slides, we have also shown a bit how this can be handled in our GLC tool, but the same will be for other tools, of if you do the calculation in IFRS. So we will enter our contract as from the 1st of January, but the payments will only start as from the end of Q1. Here you will see then the calculation of your you will see how the payments go. So at the end of Q2, Q3, and Q4, you will have your payments of 30,000 euro. And in case you're working with GLC and you have a rent-free period which is not at the beginning of which is not known at the beginning of your contract, but it pops up somewhere during your contract, like for example, you have a rent-free period because you're renting a building and there are some workings going on in the building, so you receive a discount from the lessor by having a rent-free period. Then it can also be included in GLC by using the function modification and add rent-free period, but the idea will still be the same between Belgian GAAP and IFRS. If you book the accrued expense, it's important that you reverse it for IFRS. The next topic is lease and non-lease components.
Yes, thank you, Evelien. So what payments should I now include in my lease liability? It is common for a lease contract to include both lease components and non-lease components. For example, a real estate lease may include common area maintenance services. And the general rule within IFRS 16 is to account for each lease component separately from non-lease components. So the lease component is accounted for under IFRS 16, and the non-lease component is accounted for in accordance with other standards. So you will only include lease components in your lease liability. Now, what is a lease component? A company considers the right to use an underlying asset as a separate lease component if it meets the following two criteria. So the lessee can benefit from using that underlying asset either on its own or together with other resources that are readily available, and the asset is neither highly dependent on nor highly related with the other asset in the contract. So a payment to such a lease component is to be included in the lease liability. Then what are non-lease components? Only activities or costs that transfer a good or service to the lessee are identified as non-lease components. Amounts payable for activities and costs that do not transfer a good or service are part of the total consideration, but are not part of our lease liability. Common examples for that are administrative tasks, insurance costs, property taxes, VAT. There is a practical expedient. A lessee may elect by class of underlying asset to combine each separate lease component and any associated non-lease component and account for them as one single lease component. So in this case, you will not make a distinction between the two and combine them into one payment. IFRS 16 provides this expedient to ease concerns about the cost and burden of allocating considerations to separate lease components. Although it is not explicitly stated in IFRS, but in other publications of Big Four audit companies, you can find that non-lease components mainly relate to services contained within the lease contract. So therefore, when a lease includes a component related to the purchase of inventory or another asset, such as PP&E, the entity should separate asset purchases from the lease components and account them for under a different standard. Also, when there's such a service component, you cannot use this practical expedient. What are the practical challenges when we have company car leases? The common accounting judgment is to separate each component into the different categories. So for company car leases, you will have one lease component being the payments for the use of the car itself. And in many contracts, this can be based on the estimated usage, but that is something that Evelyn already explained. If it is partially variable, this variability, and it is not depending on a rate or an index, you should expense that part as incurred. The company car leases can also have a non-lease component, maintenance or insurance. If those are fixed non-lease components, you have the choice to apply the practical expedient to all leases of company cars and to combine it with the lease components. In all other cases, you will expense it as incurred. Then the third category are the non-components that do not transfer a good or service, and those are expensed as incurred. For example, the initial registration tax that is recharged by the lessor to the lessee, or any administration cost that is recharged. And also, mainly also in Belgium, the VAT on car lease expenses, which is partly non-deductible, you do not add this to the lease payments. And the rationale is because the VAT is not triggered at lease commencement date, but only when the invoice comes in. Next, some challenges with real estate leases. Yeah. So also again, you should divide your payments into the different components. The lease component is the periodic rent for the use of the property. And as Evelyn already explained, this can also be a fixed payment or variable, depending on an index or a rate, or depending on the turnover of the shop or a number of visitors in case of in the retail sector. So if it is a variable payment, not depending on index or rate, it should be expensed as incurred. Also, when it is based on the turnover, the percentage that is based on turnover should be expensed as incurred. If the contract states that there is a minimum of 10,000 per year, then you know the 10,000 euro per year is fixed, and that can be excluded in the lease liability. Also, in case of lease payments that are indexed with 2% per year, or with the customer price index, but with a minimum of 2% per year, then you can add the 2% increase every year, because you know this is unavoidable and fixed in the future. A second category is then the non-lease component, which are the services such as cleaning, security guard, or maintenance services. Again, if they are fixed payments, you can apply the practical expedient to all real estate leases and treat them similar to fixed lease payments. In all other cases, you should expense as incurred. And also with real estate leases, we can have non-components, for example, property withholding taxes that are recharged by the lessor to the lessee, or insurance of buildings that are recharged to the lessee. These are all to be expensed as incurred. Once you have identified the separate lease components, IFRS 16 requires the lessee to allocate the consideration, which includes all payments in the contract, to the lease and non-lease components. The allocation of this consideration is in fact a two-step process. You first determine the standalone price for each component, and then you allocate the consideration. So the total consideration is allocated to each lease and non-lease component based on its relative standalone price versus the aggregate standalone selling price. But the next example will make that more clear. The lessee enters into a 3-year lease of equipment with a fixed payment of 12,000. The contract details the fixed annual payment as follows. So the 12,000 is partly 9,000 for the rent, 2,500 for maintenance, and 500 for administrative costs. In addition, the contract requires the lessee to pay for the restoration of the equipment to its original condition, which can be a variable amount, at the end of the 3-year period. So if we analyze this contract, it has 2 components. First, the lease component, which is the actual rent of 9,000. Then we have a non-lease component, being the maintenance of 2,500. And the amount for the administrative tasks is not a lease nor a non-lease component, as it does not transfer a good or service. Also, the amount for restoration does also not transfer a good or service. So at initial accounting, what do? We have the total consideration of 36,000 being 3-year 12,000 euro. And we divide that between lease component and non-lease component. So the lease component will then be 36,000 multiplied by the payment for the lease component divided by the sum of the payment for the lease component and the non-lease component. So the 11,500 is 9,000 for rent and 2,500 for maintenance. And then you come up with the consideration for the lease component, which is the 28,000. Also for the non-lease component, then you do the opposite. The 36,000 is multiplied by 2,500 divided by the 11,500. And then you have allocated your total consideration. Next topic is lease term. So what is the lease term? The entity shall determine the lease term as the non-cancelable period of a lease, together with both periods covered by an option to extend the lease, if the lessee is reasonably certain to exercise that option, and an option to terminate the lease if the lessee is reasonably certain not to exercise that option. This should be assessed at commencement date. And to perform the reasonably certain test, you should consider all facts and circumstances that create an economic incentives. And IFRS 16 gives some additional guidance on what that factors could be. So first, contractual terms and conditions for optional periods compared to market rates. It will be more likely that the lessee will not exercise an extension option if the lease payments exceed market rates. Second example are costs relating to termination. Again, it will be more likely that the lessee will exercise the extension option if doing so avoids costs such as negotiation costs or relocation costs or other termination costs. Next example is a significant leasehold improvement. The lessee will more likely to exercise the extension option if they have made significant investments to improve the leased asset. Also importance of the underlying asset to the lessee's operations and any conditionality associated with the option. You should take into account also past practices, and general guidance is the shorter the lease period, the more likely a renewal option will be exercised. Then if we break down the lease term over a timeline, we have the following periods. So the first period is in fact a non-cancelable period. It is a period during which the lessee cannot terminate the contract. Now, what if the lessor can terminate, only the lessor can terminate the lease? Then the non-cancelable period of the lease includes that period covered by the lessor's option to terminate the lease. So in this case, termination options held only by the lessor are not considered when determining the lease term because the lessee does not have control over it. If we then go further, we have the lease term, which is the non-cancelable period, plus any option to extend, which is reasonably certain. If we go further down the timeline, we have then the enforceable period, and this is the maximum length of the lease, being the lease term plus any option to extend when the lessee is not reasonably certain to extend. The period beyond that enforceable period is the period where you have no contract and the lease is no longer enforceable. And that occurs when the lessee and the lessor each has a right to terminate the lease without permission of the other party with no more than an insignificant penalty. Now, what is an insignificant penalty? You should consider again all relevant facts and circumstances. So not only the contractual amounts payable, but also any significant economic disincentives. For example, cost of abandoning or dismantling leasehold improvements, or the importance to the lessee's operations, etc. Now we have some examples of termination rights. Entity X enters into a lease of a warehouse that includes a maximum term of 5 years, and after 1 year, the lessee and the lessor each have the unilateral right to terminate the lease, but with a 1 month notice period. The lease terminates 1 month after the termination notice is given, and notice cannot be given before the end of year 1. If the lease term is terminated in this way, neither party will suffer a more than insignificant penalty. So here the question is, at commencement date, what will be the lease term? Well, the lease term will be 13 months, year 1 plus the 1 month notice period, when either the lessee or the lessor has the right to terminate a lease at any time on given notice to the other party. The non-cancelable period of the lease includes that notice party. Second example, Entity X enters into a lease of equipment that includes a non-cancelable term of 1 year. However, the lease will continue for up to 4 additional years unless it is terminated by either party. Each party can terminate the contract by giving notice to the other party at least 30 days before the end of the year. If the lessee terminates the contract, the lessee has a contractual obligation to pay the costs of transporting the equipment back to the lessor's location, and important here, transportation costs are significant. Equivalent equipment is readily available from other suppliers at similar rental prices. However, again, important in this case, installation costs are significant, and excess operations depend on the equipment. So same question, what will be the lease term at commencement date? In this case, it will be beyond 1 year. The contract will be enforceable until it can be terminated by X with no more than an insignificant penalty. As the lessee and lessor both have a right to terminate, but only the lessee's termination rights give rise to a more than insignificant penalty, we have the significant transportation cost, the significant installation cost, and the asset is important for excess operations. So it will be likely that the lease will continue beyond that 1 year. However, to assess what will be the actual lease term, then you need additional facts to determine that. The next example is in fact the same circumstances. However, there are no significant penalties. So transportation costs are minor, the installation costs are minor, and even though excess operations depend on the equipment, the idle time is short because there is no significant installation process. Same question. What will be the lease term at commencement date? This will be 1 year. Excess termination option at the end of year 1 does not give rise to a more than insignificant penalty. If we would modify this example and only the lessor would have the right to terminate the lease, for example, at the end of year 1 to 4, then we should, considering that only the lessor can elect to terminate the lease, then the enforceable period will be 5 years, because the non-cancelable period always includes optional periods controlled by the lessor. Next example is a common lease contract for buildings under 369 regime. So the contract has a duration of 9 years. X can terminate the contract every 3 years without a penalty, provided a 6-month notice is communicated to the lessor. After 9 years, X has the right to renew the lease. However, the lessor can only refuse a renewal in specific circumstances. So if he would reconstruct the building, or if he would occupy the building himself, or if he has found another party who wants to lease at a higher price, or changes in destination of the building. If the lessor would refuse the renewal of the lease for another reason, the lessor is required to pay a significant penalty. So first question, what is the maximum lease term? A lease is no longer enforceable when the lessee and the lessor each has the right to terminate the lease without permission from the other party with no more than an insignificant penalty. That is the definition. The circumstances under which the lessor can terminate the contract after 9 years are in this example so wide, including a better offer from another tenant, that you do not see a rational basis for the lessor to renew. In other words, the circumstances foreseen in the law for the lessor to terminate after 9 years are sufficiently substantive to take the view that the lessee has no unilateral enforceable right to extend beyond 9 years. So hence, the maximum lease term is 9 years. Does that mean that your lease term is 9 years? No. There you need to consider whether the lessee has a unilateral right to cancel the lease after 3 or 6 years. And the optional period should only be included in the lease term when it is reasonably certain that the termination options will not be exercised by the lessee. So in this case, it is clear that significant judgment may be required. Then after commencement date, LAC reassesses whether it is reasonably certain to exercise an option to extend the lease or to purchase the underlying asset, or not to exercise an option to terminate the lease early. The lessee will do this when there has been a significant event or significant change in circumstances that are within its control and affects whether it is reasonably certain to exercise those options. IFRS 16 provides a number of examples of significant events or changes in circumstances. So, for example, significant leasehold improvements that the lessee did not anticipate at the commencement date, or a significant modification to or customization of the underlying asset that was not anticipated at commencement date, the inception of a sublease of the underlying asset for a period beyond the end of the previously determined lease term, and a business decision of the lessee that is directly relevant to exercising or not exercising an option. That brings us to the next topic, modifications. So how is a modification defined by IFRS 16? The definition is a modification is a change in the scope of a lease or the consideration for a lease that was not part of the original terms and conditions of the lease. That last one is very important, so that was not part of the original terms and conditions. We give a number of examples. So a change in index or payments due to a market rent review is not a modification because that was already included in the original terms and conditions. Also, a reassessment of purchase options is not a modification. New purchase options is a modification. Changes in lease terms, changes in the scope of the underlying asset, changes in lease payments are all modifications. Also important to note, when there are modifications, you should consider whether you need a new discount rate. And here in the table, it is identified when you should use a new discount rate and when not. Once you have established that your change is a modification, then you should check whether you have a separate lease. So a lease accounts for a lease modification as a separate lease if both of the following conditions exist. So the modification increases the scope of the lease by adding the right to use one or more underlying assets. For example, you rent a new floor or a new machine. And the consideration for the lease increases by an amount that is equal with the standalone price for the increase in scope. So this means the increase in the consideration needs to be equal to the standalone price. If the lessor would have leased the additional floor to a third party, would that be at the same price? It can, of course, be a bit different if the lessor gives you a certain discount for not having additional costs to search for a new tenant. And then you can deduct that from the standalone selling price. In this case, the lessee accounts for the separate lease in the same way as any new lease and makes no adjustment for the accounting for the initial lease. If these criteria are not met, you modify the current lease contract. And then you allocate the consideration in the modified lease, you determine the modified lease term, you remeasure the lease liability by discounting the revised payments with a revised discount rate, and the corresponding adjustment will be to right-of-use assets. You can have a P&L impact if the modification is a partial or full termination of the lease, but we will explain further with examples. So first example, the lessee enters in a 10-year lease for 2,000 square meters of office space with a monthly rent of 10,000 euro. In year 6, lessee and lessor agreed to add an additional 1,000 square feet of office space for the remaining term with an additional rent of 4,000, which reflects current market prices adjusted for a small discount. So accounting for the lease modification in year 6 should be as a separate lease because the modification grants the lessee an additional right to use the assets and to increase the consideration for the lease, which is equal to the standalone price. Next example, increase in lease term. So the lessee enters into a 3-year lease of a car starting the 1st of March 2022 until the 28th of February 2025. The quarterly advance payments are 2,500 and the interest rate implicit in the lease is 2.5%. At the 1st of October 2023, lessee and lessor agreed to extend the lease term with an additional 1 year and the same quarterly rent payments. So because there are no renewal options in the original lease, this is not a reassessment of the lease term. This is a lease modification that increases the lease term and does not result in a separate lease as there is no additional underlying assets. How you should account for it. So you credit your lease liability and you debit the right to use assets. And in now 9,489 euro is in fact the discounted amount of the 10,000 extra lease payments. Here an attention point, if you have an increase in lease term, do check your useful life of the right of use asset. This is a snip out of our GLC tool because we already encountered an issue where the lease term was increased, but the useful life of the right of use asset was set equal to the lease term and was not increased after the increase in lease term. So you will see that before the end of the lease, we already had a carrying amount of 0. Next example, a lessee enters into a 3-year lease of a car starting the 1st of March 2022. In fact, it is the same example, but at the 1st of October 2023, the lessee and the lessor agreed to reduce the lease term with 1 year until the 28th of February 2024. So what happens then? We debit the lease liability for 9,700. And that is in fact the discounted amount of the 10,000 lease payment that was reduced. And then the offset account is a right of use asset, but that's a calculation. Maybe I will show first this one. So this is also a screenshot out of our GLC tool. So before the lease term reduction, we had a carrying amount of 13,545. That amount in the original lease term would have been depreciated over 516 days. So GLC calculates in days. And what do we want? As the lease term is decreased from the 28th of February to the 1st of October, we only want to depreciate over 151 days. If we then make the calculation what we want the carrying value to be, that will be 3,937, being the 13,500 multiplied by 151, the remaining days, divided by the 516 remaining days of the original lease term. And that brings us to the posting that we have here. So you see that the impact on the right of use asset is not equal to the impact on the lease liability, and the difference is recorded in P&L. And here you can see a screenshot from the lease liability, in which in the column gross liability, you see the decrease of 10,000 lease payments, and in net liability is a discounted amount of 9,700. Then last, we have some other considerations with regard to modifications. A lessee and lessor may agree on a modification to lease contracts that start at a later date. For example, in the beginning of year 8, lessor and lessee agree to a modification that will take effect as from the beginning of year 9. If that modification is with regard to an increase in scope and is not a separate lease, then the remeasurement of the liability will be at the date of the modification, being year 8. If it's an increase and it is a separate lease, then the new lease will be measured and recognized at the beginning of year 9. If it is a decrease in scope, that again, the remeasurement will be performed at modification date, which is the beginning of year 8.
Let's now jump to the discount rates. As you know, future lease payments will be discounted to arrive to the lease liability, and you can discount these payments using the interest rate that is implicit in the lease. That is the rate that causes the present value of the lease payments and unguaranteed residual value to be equal to the fair value of the asset at initial, plus any initial direct cost incurred. However, you should note that this is seen from the perspective of the lessor, and it is often difficult to have information about the unguaranteed residual value of the lessor. If this rate is not readily available, you can choose to use an incremental borrowing rate. Actually, when you transition using a modified retrospective approach, the incremental borrowing rate is mandatory as well. What is an incremental borrowing rate? This is rates that you would pay to a bank to borrow over a similar term with a similar security and in a similar economic environment. You can also choose to use other rates, such as property yields, to estimate an incremental borrowing rate. How do you make such an estimation? Well, you can use a reference rate, for example, this property yield, and then you can adjust it using, for financing spread adjustments, using, for example, government bonds, the rate of government bonds with different durations. As Nele also said, the discount rate is determined at the commencement of the lease, but is also revised after a modification or after a reassessment of a purchase option or a termination option. Next, we will jump to some specific topics. No, first of all, sorry. The discount rates in GLC are set by determined by asset class, by currency, and by country, actually. And you can also specify divided by different buckets of duration. So you put this in the settings, and actually GLC will determine which is the correct interest rate for your lease based on which currency the lease is paid in, which country, or which country it is, and which asset class, of course. Next, we will jump to some specific topics, and first of all, the portfolio applications. So, as you know, if the asset can be operated on a standalone basis, the right to use that asset should be accounted for as a separate lease component. However, you can opt for a portfolio approach when you have a large number of similar assets. You can do so provided actually that such aggregation is not expected to have a material effect on your financial statements. For example, you have one contract to lease 20 forklifts. If all these leases have similar characteristics, you can choose for a portfolio approach. Next, we have the short-term exemption. So you can choose to apply a short-term exemption if a lease at commencement date has a lease term of 12 months or less. The lease term is not only the non-cancelable lease term, but also periods covered by an extension option if you're reasonably certain that you will extend, or a termination option if you're reasonably certain that you will not terminate the lease. This exemption can be made, should be made by class of underlying assets. And when you choose to use this exemption, you just recognize the payments in profit and loss. This is determined at commencement date. So in the future, if the lease is reduced to less than 12 months, you cannot decide that now it becomes a short-term lease and you will use the exemption. On the other hand, actually, when you have a short-term lease at commencement date, but then a modification happens or a reassessment of the lease term, and the new lease term is not short-term, then you will assess this as a new lease. For example, imagine that you have a contract that is renovated yearly, and the notice period is 3 months. At the beginning, you only know that you will rent it for 1 year. But when the notice period arrives, you know that you will rent it for these 3 months plus 1 year. You see this as a new lease, and this new lease will not be short-term anymore. Finally, you can also not choose to apply this short-term extension if the lease contains a purchase option. And now we'll jump over to purchase options. So purchase options are included in the lease liability and the right of use asset if they are reasonably certain to be exercised. Important to note is the depreciation period. So in general, a lease is depreciated from the commencement date to the earlier of the end of the useful life or the end of the lease term. So from commencement date, so the date that not the date that you start to use the asset because of, for example, leasehold improvements, until the earliest of the end date or the useful life. This is the issue that Nela had covered under the modification. For example, if you reassess a lease and you choose to extend it, please always revise that the useful life does not become shorter than the lease term, because then you will have depreciated the assets before the lease has ended. On the other hand, when you have a purchase option, the asset will be depreciated over the useful life. So important is, for example, in GLC, we will see this with an easier example in GLC. We have a lease term of 36 months, but the useful life of the underlying asset is 60 months. And as there is a purchase option, so a transfer of ownership, at the moment of transfer, the asset will still have the rest of the useful life to be depreciated. So you still see that the carrying amount at the date that the purchase option is executed is not 0. On the other hand, you do see that the net liability at period end is 0.
Okay, the next specific topic we want to discuss is the lessor accounting. So in case you are the lessor, it's important that you do the lease classification test, because your lease can be a finance lease or it can be an operating lease, and other accounting treatment is required. So in case you will have a finance lease, in case you transfer substantially all risks and rewards to the ownership of an underlying asset, and in that case you will account for a receivable which is equal to the net investment of the lease. If you have an operating lease, that means that you do not transfer substantially all the risks and rewards, then you as a lessor will still continue to recognize your underlying asset, and you will continue to account for it in accordance with the applicable accounting standards. So it can be IAS 16 PP&E, but it can also be IAS 14 in investment properties. But how do you now determine, okay, do we really transfer substantially all risks and rewards? To do this lease classification test, the IFRS standard has some examples which individually or in combination can lead to a lease to be classified as a financial lease. So the first one is in case the lease transfers the ownership of the assets to the lessee at the end of the lease term, then potentially you will have a finance lease. In case the lessee has the option to purchase the assets at a price that is expected to be sufficiently lower than the fair value at the date of the option becomes exercisable, then it's also a sign that you potentially have a financial lease. The most common example that we see is in case your lease term is the major part of your economic life of the asset, even if the title is not transferred, then potentially you also have a finance lease. So assume you are leasing a building for 99 years, okay, then your lease term will be the major part of the economic life of that asset, and potentially you will have a finance lease. If at inception date, the present value of your lease payments amount to at least substantially all of the fair value of the asset, then again, potentially you will have a finance lease. Another example that's included in IFRS 16 is in case your asset is of such a specialized nature that only the lessee can use it without a major modification, then again, potentially you will have a finance lease. It's important to note that those are just like some examples which are described within IFRS. It's not a list. The list can be extended with other examples. It's just to give you an indication. And a lot of judgments will pop up when doing this lease classification test. As you also see in the examples, it's referring to major parts, substantially, but it's not defined within IFRS 16 what exactly is now a major part. What do you mean exactly by substantially? So it's important that you really do a good assessment, and potentially with your auditor you will need to discuss the judgments that you made to be sure that they agree with your lease classification. When you do a lease classification for land and buildings, then it's important that you do the lease classification test separately for each element. So it means that your lease payments needs to be allocated proportionally over the land and the building based on the relative fair value that they have at inception date. In case you cannot allocate reliably the payments between your land and your building, then the entire lease is classified as a finance lease, unless it is clear that both elements are compliant with the requirements for an operating lease. It's also possible that your land element is not material to the complete lease, and in that case, you can also see the land and the building as one single unit and do your lease classification test for the land and the building together. It's also important that in your lease classification test, you include the residual value guarantees. So those are the guarantees those guarantee of a residual value at the end of the contract, and that guarantee is provided by the lessee or by another third party. So if you have a finance lease at commencement date, you will de-recognize your asset and you will recognize a net investment in the lease. After commencement date, you will reduce that net investment in the lease for the payments you have received, and you will also recognize a finance income. So that's a bit similar with the lessee accounting. There you will also have a decrease in your lease liability based on the lease payments you do, and you will also have a financial expense for the unwinding of the discounting of your lease liability. Some key concepts within the finance lease is that so you need to recognize the net investment in the lease, and the net investment in the lease is in fact your gross investment in the lease, which is discounted at an interest rate implicit in the lease, and that's the interest rate implicit at inception date. But what is now the gross investment? So the gross investment in the lease is the sum of the lease payments that you receive from your lessee, plus the unguaranteed residual value that you have from your that you receive as a lessor. But let's maybe jump into an example. So we have a 10-year lease of an equipment, and the annual payments are 15,000 euro. You know you have a residual value of 50,000 euro, of which 20,000 is unguaranteed and 30,000 is guaranteed. The carrying amount of your asset is 100,000 euro, and your implicit interest rate is 10.078%. So if we go to the booking, we know we need to reverse our assets. We need to de-recognize our assets. So meaning we will do a debit of the property held for the lease for an amount of 100,000 euro. So that's the carrying amount that we see on this slide. Then we also need to recognize, so we need to debit the net investment in the lease. In our example, this is 111,000 euro. And this is the sum of the net present value of your lease liabilities, including the guaranteed residual value. So that's what we see in the first column. So the lease payments are 50,000 euro, and at the end you have a residual value, a guaranteed residual value of 30,000 euro. So the net present value of this is 103,000 euro. Then we also need to add the net present value of the unguaranteed residual value. So that was the 20,000 euro at the end of the contract, and the discounted amount of that is the 7.6k euro. So the sum of those two is recognized as a net investment of the lease. To make your booking complete, you also need to credit your revenue for the net present value of your lease payments and the guarantee residual value. So that's the 103k that we see here. So in fact, this will mean that you will already take upfront all revenue that you will receive via your lease payments. And to conclude the booking, you will also need to recognize a cost of goods sold. This is the amount of your carrying amount, so the 100,000 euro, minus the net present value of the unguaranteed residual value. So, okay, at commencement date, we have performed a booking, but what do we do subsequently? So subsequently, we will receive on a yearly basis a lease payment of 50,000 euro. So we have a debit in our cash. And the credit is then, on the one hand, we have the interest income, which is 11k euros. So that's just the unwinding of your net present value of your net investment. And you will also credit your net investment for the difference between the cash you receive and the interest income you have booked. So again, this is a bit similar as within the lessee accounting, because there you will have a credit on the cash and your debit will be your lease liability and an interest expense. So the idea between lessor and lessee accounting is the same. In case you have a lease modification as a lessor, it's as Nela already explained for the lessee accounting, it's again important that you determine whether that you reassess whether you have an operating lease or not. So in case you have an operating lease, if you have a lease modification, that lease modification is threatened as a new lease as from the effective date of your modification, and you need to do your classification test again, and the criteria needs to be reassessed. In case you have a finance lease, you will need to conclude whether it's a separate lease or whether it's a change for the existing lease, so not a separate lease. And that's the same as how Nela explained for the lessee accounting as well. Here again, if you have a separate lease, the classification criteria needs to be reassessed. To conclude this webinar, also a quick reminder on an amendment which was published related to lease liability in the sale and leaseback. So there was an amendment issued in September 2022, which becomes applicable for accounting annual reporting periods beginning on or after the 1st of January 2024. So that's potentially the next reporting periods. Relevant for the next reporting period. An early application of that amendment is permitted, but then it needs to be disclosed. In this case, if the seller and lessee shall apply then this amendment retrospectively in accordance with IAS 8 to the sale and leaseback transactions entered into after the date of the initial application. But what was now included in that amendment, the amendment clarified how the seller lessee subsequently measures the right of use asset and the lease liability arising from a sale and lease back. And it specifies, it clarifies a bit more that the subsequently measurement is in fact in line with the existing requirements for IFRS 16. So for a normal IFRS 16, how you subsequently need to measure the right of use asset and your lease liability is the same in case of a sale and lease back. But to clarify this a bit more, they stress the fact that after commencement date, seller lessee cannot recognize an amount of gain or loss that relates to right of use, which is retained at the seller lessee. But of course, it does not prevent the seller lessee from recognizing any gain or loss related to the partial or full termination of a lease at the moment you do the sale and lease back. Okay, so this was our webinar. We are just looking into the chat and in the questions chat, but we do not see any open questions. We will give you maybe a little bit time in case you would have questions to raise them now. In the meantime, maybe just a reminder that on the 13th of December we have our last webinar of this webinar series. So we hope to all welcome you on the 13th of December. We do not see any questions in the chat and the question list, so I think we can conclude this webinar. Thank you for your attention.